Hi, people. Thank you for stopping by Building Wealth with Rajiv. Here's my chat with an extremely experienced and accomplished investor who wants to remain anonymous. He goes by name StockNovice at Twitter. His portfolio blossomed 6 times in the last 3 years. That's incredible. StockNovice and me talked about a couple of things. Number one, how does he decide on the companies? Why does he invest in those companies? When does he sell those companies? What are his entry and exit criteria? Does he use any technical analysis? And how does he value the company? It's an extremely meaningful conversation. I hope you enjoy it. If you enjoy it, please follow the channel. Press the bell icon so that you get notified. Thank you. Hey, Joe, thank you for giving time, precious time of yours. I'm truly grateful.
No, I greatly appreciate the invite and definitely look forward to the conversation.
Yeah. Joe, I think let's get into the business straight away. I think stellar record, fantastic record. How do you choose companies?
What I learned in choosing companies, first of all, and I think it's important, you say the word companies, and it really was important for me as an investor when I learned that we talk about buying stocks, but we're not actually buying stocks. We are buying a piece of a business. We're becoming a part owner in a business. And I think to your point, when you talk about picking companies, it's about picking companies that resonate with you. And it could be something about the business that they're in that you're familiar with. It could be something about their business performance, that they hit certain key metrics or certain key things that you look for, which is what I tend to do. Some people like to do it in businesses that or industries that they're familiar with, in a vertical that they're familiar with, or a space that they're familiar with. And I think the main thing in picking those companies as an individual investor is to come up with a system or a process that works for you, that you can one, be consistent in how you select them, and then more importantly, two, have an idea of what your expectations are for those companies, and then holding them accountable to meeting your expectations. So most of what I do is through looking for specific metrics. I'm looking for combinations of growth, revenue growth, customer growth. If it's a software company, I'm looking for maybe net retention rate, or I'm looking for operating margins, or I'm looking for leverage that they're doing with their execution. And I want traits that tell me that a company has a chance to be a dominant business. Because if it has a chance to be a dominant business first, then the odds increase that it has a chance to be a dominant stock. And it doesn't always work out that way. But I know if I pick dominant companies that have very strong business performance, I have a better chance of ultimately outperforming the market with my investments.
Awesome. Now, and then let's take it further. Let's talk about the top holding you have and why.
The top holding I have right now is Datadog. Datadog is a tech company that is in a couple of different spaces. They do observability, where companies can monitor their apps and their technology that they have. They also have they take care of some security as well, making sure that all those things are secure and the companies know what's going on. They also do some development ops where they help people as they're building software on their own to be able to cross-check, see where there might be problems. They do log management, where they're able to keep a lot of that data so that they can give you a kind of an end-to-end view of what you're doing from an infrastructure and technology standpoint. And I know that sounds pretty fancy, but I have very limited kind of practical tech experience. I don't code. I didn't work in the technology industry, but just knowing what the company has done and owning them for as long as I have a good idea of what they do. And what they've done business-wise is they are a very innovative company. They've kind of disrupted their space. They're accelerating growth at an incredible rate. They're adding customers every quarter. They are now, they're generating tons of free cash flow. They've now turned positive. And if you think about the S curve, which I know most people are familiar with, the bottom of the S curve, and then you're going to hopefully get a very steep slope upwards until eventually a company matures and flattens out. Datadog, for me, of the companies that I own, is A, the one I understand the best because it's one of the ones I've owned the longest, but B, it's also one right now that I believe has the most attractive S curve. And when I know it very well, I have high conviction in it, and I really like where it's at on the S curve. That's kind of the triple whammy for me, where I want to make sure that one has the largest allocation, and I'm putting most of our capital to work in that. That's where Datadog is at right now. It's probably about 26% of our portfolio right now.
So when you started with, I think, look, there's a lot of debate between concentrated and diversified portfolio. Joe, you're aware of that, right? And I think 26% in one holding is pretty concentrated. When you chose Datadog, how long ago was that?
I've owned Datadog, I want to say, since probably a couple of years now, about December 2019. They haven't been public for a long, long time. They were an IPO company, had very, very strong numbers. I want to say I probably bought in about 6 months or so after the IPO. But I think what's really important is when I say that Datadog is 26% of our portfolio, I have not put 26% of our capital into Datadog. Datadog has grown to be 26% of our portfolio. And I know we talk a lot, about letting winners win. Datadog has been that type of stock. It has grown into that portfolio. I'm not afraid to push a company into the 12 or the 15% range, sometimes by putting capital in. But for the most part, once it gets to that point, 15, 18%, if it grows that big, and I've had a handful of companies that have done that, I just tend to let them go. And I have not really added shares to Datadog at all. Datadog has done all the heavy lifting to earn this big of a spot in our portfolio. And as long as the company keeps performing the way it has, I don't want to penalize it because it's our number one performer. I want to reward it because it's our number one performer and let it run in our portfolio. And so far that has worked out. And as I said, it's grown to our largest position by far.
So I think let's go back. I think I just want to get a little bit deeper into Datadog, not into the business, but more into your thinking, Joe. So when you took Datadog in the beginning, what did you look at? I mean, what attracted you, and what kind of price you wanted to pay for that? How did you decide all of that?
Well, the one thing I'll say right off the bat, I don't pay as much attention to price or valuation as some people do, just for the simple fact that if I am focusing solely on trying to buy the most dominant businesses that I can, I know that they're going to be expensive by nature. They're going to be expensive. These companies are the best companies in the market are expensive. They always are expensive. And yes, sometimes you have to challenge yourself on your willingness to pay a price for a company. But what really appealed to me about Datadog was it had very high growth. I want to say when I first bought it, might have been like in the 80% a year. It was growing rapidly quarter over quarter. They were growing customers hand over fist. They had started with one product and had grown to about 9 products. They had several customers that were using 2 products and 3 products and 4 products, and they were releasing those numbers and they were going up every quarter. So not only were they landing new business at a very strong rate, but they were expanding their business very strongly within the existing customer base. And when you get that, we talk a lot about land and expand. When you're landing at a very high rate and you're expanding at a very high rate, those two things kind of magnify each other and can exponentially help grow the business. And Datadog fit that mold. They had very strong gross margins. They were, at the time when they first came out, were not yet a profitable company, but they have since turned profitable, and they've gone in that direction and done very, very well. Their margins are strong every quarter, and they had a little bit of a glitch in quarter 2 of 2020, where they were really doing very well, and COVID hit, and COVID affected a lot of businesses, and it affected Datadog as well. Not necessarily that they stopped gaining customers, but most of their customers decided to kind of optimize their usage, and that caused a dip in quarter 2 of 2020, which also put a dip in the stock. But at the time, looking at it and continuing, because we knew the company and I knew the company, looking at it, I saw that it was just a temporary dip. The business was accelerating. All the numbers and the management comments said, "Hey, we get it, a little bit of a stumble, but it's going to get right back on track here." And to their credit, it has. And a company that had, grown from the 80s and then quickly fallen into like the 60% growth, which is 60% still strong, but 80 to 60, relatively speaking, is a fairly significant drop when it happens after only a couple quarters. But as they came around from that, They accelerated back up. They eventually dropped, I want to say, around kind of the mid to high 50s, and then went back into the 60s. And then this past quarter, we're back up to 75%, and look like, again, they should be a 70%, grower, or have a chance to be a 70% grower. So you have a company that is scaling, creating leverage, gaining profits, and accelerating their top line. And those are very rare companies in the market. When you find one, in my opinion, it's worth paying a premium price for and holding on to, because it's that type of performance that deserves a premium price. And when you get the exponential of the land and expand coming together, what that does is that's where you get your beats. Most of our valuation models are linear models. And when you have a company or a business that has a chance to grow exponentially, that ends up leading to outsized performance. And you're never going to bat 1,000, but you don't need to bat 1,000 with these companies. You just need to be right more often than you're wrong. And so far, Datadog's been a very successful investment for us, and I think for most people that have owned it.
Okay. No, I think that's pretty good. One thing I want to ask Joe is, when you are looking to invest in a company, how do you start? I mean, you start with certain rate of return in your mind that I want to get 20%, 25% a year from this company, or
no. It's the business. I guess the best way to think about it. I tend to own somewhere between eight and 10 companies. I believe I have 9 right now. And those are my best 9 ideas. Those are the 9 businesses that I like the best. And when I have a new business that comes in, and when I look at that business, what I'm going to do is run that business through the same exact checkpoints that I've run every other business through. And then I'm going to see where it falls. And if it falls in the top 9, I might bump something out. If it falls 10th, I might decide to add a 10th position. If it falls 5th, I might add it in and slide it in higher up. And, as an example, I have no idea if I'm going to be right or not, but I just started a position in Snowflake, and I owned Snowflake previously. I had some concerns last quarter about their customer growth. And because in their business model, for anyone that might be familiar with Snowflake, when they add their customers, they say it normally takes 9 to 12 months for their customers to ramp up. So even if they have really strong revenue growth right now, that revenue growth is coming from customers 3 to 4 quarters ago. So they had some soft customer ads, I thought, in quarter 1, and I had some concerns as to whether in quarter 3 and quarter 4 that customer cohort, that group of customers, would be able to carry the growth or maintain the growth in the back half of the year. And you know what? Snowflake proved to me with quarter 3 that was not going to be an issue. They accelerated their growth again to about 110%. Their customer growth was great. They had one of their first profitable quarters. They were cash flow positive, and they were very, very positive with their call comments and all the underlying things they have going on with their business. And I took Snowflake from a 0% position to about 7.5. I want to say it's maybe my 4th or 5th highest position right now, mostly because I have to give the company the credit. If I'm going to hold these companies to these performance standards, and Snowflake throws up the type of performance that it did, it went from really not being in our portfolio to being what I thought might be my 4th or 5th best idea. And I need to act accordingly and put it in an appropriate spot in the portfolio. So, as I'm looking at new companies, you're always comparing it against your alternatives. Zscaler had a tremendous quarter. My conviction went up. The allocation went up in Zscaler. CrowdStrike had a good quarter, not a great quarter. My conviction in CrowdStrike didn't go away as a business, but compared to the other alternatives that I had, I like Snowflake's quarter better. I like Zscaler's quarter better. I like Monday's quarter better. I like Datadog's quarter better. So now CrowdStrike, which began the year at my number 1 position, with all those other companies, I feel like their business is being in a better spot. Doesn't mean I'm right, but me feeling that those businesses are in a better spot, I bump my CrowdStrike position down accordingly to make sure that my allocations line up with the strength of conviction I have in each of those businesses. And it's all relative in as to where it all fits in the portfolio and how many names I'm comfortable holding. And I think that goes for anybody. Everyone has their own number that they have to hold to be able to sleep at night. And I know my number is lower than most, but the same thing applies. You still have to feel, you still have to, at the end of the day, have to be comfortable with what you own, and more importantly, why you own it.
All right. And okay, now, how do you find the next successful companies? What's the process? Like, how do you hunt around for the companies? Because I saw a lot of your companies are SaaS companies, right? Majority
Correct.
yeah. So how do you find the winners? How do you say, okay, now what are the sources? Is it Twitter, or is it, some screener?
You know what? I don't screen. I don't do a filter. Most of my sources it's crowdsourcing. I get it through, and I know, you and many of the listeners that are online are going to be familiar with Saul's investment discussions with the Motley Fool. I get things through Saul's. I get things through Twitter. I don't really have any services that I subscribe to per se. Usually what happens is through culling down the list of people that I follow on Twitter, culling down the list of people that maybe post on that board, or the sources that I have, and running such a highly concentrated portfolio, you're not really looking for a needle in a haystack as much. Most of the time, these names will be presented because, especially if you're in the software industry, or you have a little bit of an idea of smaller companies, a lot of times you hear about these companies even before they IPO. So the sources that I use, it's really just crowdsourcing is where I get the majority of my ideas. The other thing where I get a lot of ideas from, and I've talked about this a little bit in the past for people that might have heard me talk before. One of the things that people do on that board at the Motley Fool at Saul's is monthly they will post their portfolios, and because everybody's using a very similar process, usually the top 3 or 4 holdings are pretty similar, and the allocations might be different, but in general, the top companies are owned by most of the people. I'm more interested when I see those in more the back half of people's portfolios, because I think that that's where the differences of opinion come up, the differences in style come up. And sometimes the companies on my watch list are actually companies that I do not own, that other people that I follow and respect do own for whatever reason. And sometimes my due diligence, just as much as I might look at the company, it might be reaching out to someone and going, hey, why did you decide to buy this company? And why do you have it in your portfolio? So I really think just over the course of time of doing this, I've gotten enough of a contact list and a follow list where most of the ideas that I get don't come from mechanical screens, but more from the crowdsourcing of the sources that I follow, whether it be online through social media, or people that I know individually, that I speak with individually, who might have similar investing styles.
Awesome. And when do you take profits? I mean, for example, let's say Datadog. Do you see, because there is a one thing which is value, there is one thing which is price. Now, when do they
Correct.
marry each other? God knows. I mean, at least I've not been able to figure out. I know people call it price will eventually go to the value, and value will come out to price. But what the hell is that exact point? God knows. Now, how do you find the stock is stressed or the price is stressed? Do you sell based on that, or what do you do? I mean, for example, right now, if you look at, Joe, the market is kind of a not constipated, it's having a massive diarrhea.
Right.
And,
right.
And the stocks, some of the business stocks, what do you call, are at unfavorable prices. I mean, at a very favorable prices, right? But let's
Right.
say I talk about my holding C Limited. It was 340, 50, 60 2 weeks ago. Now it's 247, and nothing has changed.
Right.
I mean, their quarter was good. So I wonder, should I have sold and taken some profits that time? I mean, I'm just kind of kicking myself in butt.
I think we all do that. Excuse me. First of all, I think we all do that. You also would be kicking yourself in the butt if you sold it at 350 and it was 425 now, after you knew that it had a great quarter, because you said, I like the company, it had a great quarter, and the stock price went down. That happens, and that's volatility, and we can't control the stock price. We can control the methods that we screen the businesses. And for people that might have followed my Substack, I struggled a little bit. I don't really care as much about price. I get it sometimes that companies are extended, and multiples go up and multiples go down, but they tend to move fairly relative. There are instances where maybe something gets a little disconnected. I did trim Cloudflare a few months ago because I thought that got a little disconnected, but I still want to own it. I still own like 6% of it in our portfolio. And at one point, Cloudflare was, I want to say 12 or 14. And when it got up to, 185 or 150, 175, 200, I did trim it down because at some point that felt a little bit disconnected to me. But in general, I'm more concerned about the business. When I thought CrowdStrike was my best idea, CrowdStrike grew to almost 30% of our portfolio. And when CrowdStrike had a quarter where I didn't think it was quite the best idea, or at least to that extent where it had separated itself, I immediately cut it to like 16. And then, this quarter I cut it again, and now I'm carrying about 5% CrowdStrike. So I'm not as much worried about price as I am the quality of the business. If I want to own more of the business, I push it. And if I don't, I cut it. And I know in the last little bit, I had for people that have followed me, Upstart, I had about 22 or 23% Upstart. Upstart had what I thought was a disappointing quarter, and I immediately cut it to like 1.5. I just kept my taxable shares and I sold everything else. So I had a very, very large amount of cash especially for me, because I prefer to be fully invested. I had a very, very large amount of cash the entire back half of November. And where I really struggled, to your point, I knew the market was at all-time highs. I knew a lot of these stocks were at all-time highs. And I don't want to say price doesn't matter at all, because you do have to click buy when you buy it, and you do have to pay whatever price is prevalent at that time. But in my particular case, I had that extra cash. And then what I did was on Wednesday and Friday, when everything cratered, by Friday, I just put everything back in on Friday. And I know it went down today, and I'm not really worried about it. I know I can't time it, and I know I can't tick the bottom, but I know I bought a lot of companies that I really like a lot cheaper than they were, 2 or 3 weeks ago, with no change in the business. Historically, the market has told us that that's a good buying opportunity. But to your point, you do have to kind of overcome the psychology of actually, buying the stock when that happens. So I don't have any cash left. I got asked a ton by people that follow me, what I was doing when they were down, and all my cash is back in. So, I bought Monday on the way down. I bought more Zscaler on the way down, and I'm happy to own those companies because I feel like, 1, 2, 3, 4 years down the road, those companies are going to be much, much larger than they are today. So I don't want to quibble over $1 here or $1 there. I wanted to own more of those businesses, and the market was telling me they were on sale. So that's what I did.
Okay. And have you sold a business, or have you sold a stock at a loss because you were not convinced?
Oh, yeah. I have. The one thing I will say, and since I started this style about 3 years ago, I have sold companies for a loss. Ones that I've held long term, though, that have held a bigger allocation in our portfolio. Usually, if I sell those, I'm selling them for a profit, even if they've gone down. So, for instance, I started buying Zoom at 110, and I bought it, all the way up to like 400 or whatever it was, and I think I ended up selling out maybe around 380 when it came, but it went all the way back up to 580. And for most people, oh man, it was 580 and I sold it at 380, and look at all the money I lost. But I'm looking at it and going, hey, I bought it at 110. I bought shares at 112. I bought shares at 120. I bought shares at 140. And all those shares that I sold at 380, I made a profit on. So my losses tend to be smaller companies that are more kind of tryout positions that I have, 3 or 4 or 5% in. That I don't hold for very long because they don't meet my standards. And one of them is, I wrote about 2 of them this month on my most recent recap. One was a firm, which I owned for about 10 days. I bought some. I just could not get comfortable with the business. My cost basis was somewhere in the 140s. And I think I sold out at like 128. So I took a, whatever it was, 8 or 10% loss on a firm, but the rest of the market was down as well. So, and then also I owned a company called Docebo. And I want to say my cost basis in Docebo was around 80-ish. And I did not like their quarter. It didn't meet my standards. And I sold out. And I want to say I sold out kind of 72-ish or something like that. So Yes, I do sell companies for a loss, but I don't want to get caught up personally. I don't want to get caught up in price. Losses are going to happen. I either want to own the business or I don't. And if I don't own the business, I'm actually doing my portfolio a disservice, and all the companies that I do like, I'm doing them a disservice if I go, well, I'm just going to wait until I break even. That's market psychology. And I think we all know that more often than not, if a company disappoints and you're going to try and hold out for it to break even, there's so much opportunity cost of keeping that money not working for you with something you like better that usually ends up being a losing strategy. So yeah, I've taken plenty of losses, but I also am very, very fortunate to be able to say that the wins have far outweighed the losses. And when I think about the returns of my portfolio as a whole, I'm very happy with how they've trended over the last handful of years.
And how many quarters do you give a company? Let's say if it has one quarter bad, what does that mean for you? I mean, you kind of completely come out of it, or you kind of start shedding it, or because I saw, for example, Roku. I mean, it used to be your top holding. Joe, I've been following you, and suddenly it's out of favor with you.
Yeah, and a lot of that was, Roku had a lot of things going for it. They were clearly leveraging their platform and doing a lot of good things to be able to target ads and to increase that part of their business. And, as I was piecing it together, they are selling those ads to the viewers that view. And so they're selling them to the customers that view. And the more hours that people view, the more ads that they sell. And when the customer count went down and the viewing hours went down, well, now there's less ads to sell for a lower window of time. And even though I liked that part of the business, I didn't like what was going on in the front end. And they missed my expectations for the quarter, and I decided to move on. And that ended up being a good move because it's much, much lower now than it was when I sold. And I had owned Roku previously last year. And when I sold out of Roku the first time, I actually made a profit. That was a profitable investment. When I sold out of Roku this time, I actually believe I took a small loss on Roku this time around because of what happened. It had gone up over 400, and I can't remember exactly where I got out, somewhere below 300. But I think at the end of it, to your point, I do have very high expectations for what's expected on each quarter. Mostly because if I have a very, very concentrated portfolio and they're all dominant businesses, or hopefully dominant businesses, I want to hold them accountable to continue doing things that tell me they're going to continue to dominate. Because if Docebo doesn't do something that tells me it's going to dominate, but Snowflake, that's not in my portfolio, does do something that tells me it's going to dominate, Docebo goes away and Snowflake goes in, which is exactly what happened this quarter. And I do think that I have a long-term investor's mindset. I do think when I buy something, it's with the intent of holding it for a while. And let's say that we have a 3 to 5 year mindset or a 3 to 5 year window in mind. That doesn't mean just because I own something with a 3 to 5 year mindset, that doesn't mean that I shouldn't hold it to a very high standard for the next 3 to 5 quarters. Because if it's going to do what I think it's going to do in the long term, the short-term steps that it takes that we do have a chance to look at, those short-term steps need to tell me that the company is still on track to meet my long-term goals as an investor. And if they don't, then the thesis or my personal thesis or my opinion of the company might be wrong. And if I'm wrong, I need to pivot because I want to be right more often than I'm wrong. And admitting that you're wrong is a big hurdle to clear. But once you do it, it does make things a lot easier. Does that answer your question?
It does. It does. But one thing I'm just trying to think is, once somebody asked me, or somebody I read somewhere, is your portfolio a museum or a warehouse?
Right.
And I think you seem to be more on the museum side, right? You want to have very selective.
Yeah. Yes, I want the if you want to use the museum analogy, I want the best 8 or 10 priceless things that I can show in my museum, and if I get a chance, if I've got a Picasso in there already, but a more rare Picasso comes along that more people are interested in or more people want to see, I'm going to put that in my museum. So it's a very limited slot. It's one of the things I've learned. I think everyone needs to set what their standards are. I'm not saying that everyone should run a highly concentrated portfolio, because I don't think that that's right for everyone. I think you need to find what's right for you as an individual investor. But I do believe that anyone that is going to manage their own portfolio, whether it be stocks or whether it be bonds or whether it be crypto or whether it be NFTs, whatever it is, you have to have some sort of process. Real estate, whatever it is, you have to have some sort of process for separating quality assets from non-quality assets. And I want to make sure that I am constantly focused on the highest quality that I can. And then I take my chances. And at the end of the day, we're all taking our chances and whether or not our investments are going to be higher. But if I'm going to take my chances, I want to take my chances on the highest quality items that I can find.
Yeah, I think that's look, I think what I'm understanding, Joe, portfolio construction is a very personal thing, I guess.
Yes.
And I think it's something which is very close to your own belief system, your own value system. It's much more than just selecting companies, I guess.
Yes. Yeah. And I think that's important. That's important. I know that might not be a question, but I do think that point is worth making for everyone that listens. It really doesn't matter what you are investing in, what asset class you're doing, what your style of investing is. You have to there's a reason that you're investing, whatever your goals might be. You have to find a style that aligns with your goals. I think that's where people tend to have the most difficulty. The first thing we want to ask is, what should I buy? What asset should I buy? What should I own? And we talk about the what. The more important thing is why you are investing. What the goals are that you're trying to meet as an investor. So, when you say to me, or if someone says to me, hey, what should I buy? I don't know. What are you trying to accomplish? What's your time frame? How much money do you have? What's your risk tolerance? What's your temperament? All those things are, how much time do you have to track your investment? So all those things matter. And we constantly want to run into buying whatever we buy. And we don't spend enough time sometimes just kind of educating ourselves on what we're actually trying to accomplish. Because when you understand what you're trying to do as an investor, it does make it a lot easy. Like I know that real estate doesn't fit my investment style. So I'm not really paying attention to real estate. I know that with crypto, I don't know enough about it. I know some have technology behind it. I know some are some are more meme coins. It's very driven by investor sentiment. I prefer to have things that I can track more. So I'm not worried about, what crypto might be doing or what real estate might be doing. But that's just me personally, and I really think it's important for anyone that's listening. You need to have a process to determine what fits for you. You need to be able to sleep at night. And I think what happens is sometimes in these types of interviews, I am not stumping for a style. I'm stumping that everyone should find their own style. And once you find it, you'll know. And once you do, you have a chance to be a successful investor.
I get it. Totally appreciate. Now, Snowflake, for example, what was your research process like? So you crowdsourced the company Snowflake. Yeah, it's a big name, and
Correct.
It's in a formidable position, as we know. And if you see the traditional price metrics, is bloody out of range.
Right.
Yeah. But what did you research about this company? So you read annual reports. You heard some people. What helped you make up your mind?
Well, I'll kind of walk through a little bit of history with Snowflake. So are you familiar with Muji? He's hyper growth on Twitter.
Yeah.
Okay, so I know Muji is phenomenal in understanding the tech behind companies, and Snowflake was a very high profile company. It was a very high profile IPO. Everybody and their brother, knew about Snowflake. It was not flying under the radar at all. It did have very, very dominant performance metrics as a company when it first came public. And I can remember when Snowflake first came out, and people were like, oh, I'd be willing to pay, $140 or $150 for, because everybody's trying to do the traditional valuation models. And Snowflake came public at about $245, I want to say. and people were shocked, and it ran all the way up to like 400. And I remember talking to Muji about it, and I actually did spaces with him on Twitter where we talked about it. And that was one for me where, yes, it was a dominant business. I thought that price was too high for even me to pay. And I know that these companies in general are somewhere between expensive valuations and nosebleed valuations. And at that point, I thought Snowflake was like a ridiculous valuation. I couldn't believe how high it was. And when it went from 240 all the way up to 400, then it might have been 390 or so, but then it circled back and came all the way back down below 300 again to maybe like 295 or so. And that was when I touched base with Muji, and I was like, hey, it's kind of gone full circle. It's got another quarter under its belt. So I know that it's still performing. The multiples compressed quite a bit. Is this a company worth owning? And I bought into it when I want to say it dropped back down to maybe as far as like 195 in one of the last washouts, like we're talking about now with stocks going down. Snowflake went down to about 200. I think I bought my first shares at like 195, and then I built it back up as we kind of went. But I always thought it was pretty expensive, so I couldn't really get too comfortable with it. And I think I got it to about 4%. And then last quarter, I actually sold out. There was a channel check report that came out that said that they didn't think the customer growth was going to be that good, and I sold out at around 280. And the report came out, and the earnings report came out, and it was right. The customer growth was just kind of okay, but the net retention rate and the amount that the current customer spend was so strong that the top line was really strong. I ended up sitting out, and it ran all the way back up to 400 again. And then after this last quarter, I built a bunch of it back up between about 330 and 350 the last few days, because now it's had another dominant quarter. It's growing 110%. I know it's expensive. I know it's a $120 billion market cap company or whatever it might be. It is doing all the things to carry a very, very high premium. And I realize there's a little bit of a tightrope act with that. But if I want to hold myself to owning dominant businesses, that's a dominant business that I want to own. And right now, my portfolio allocation is about a little over 7%, maybe 7.5% with Snowflake. If Snowflake was cheaper, it might be a 15 or 20% position for me, because I think the business is that dominant. But I think what the price has done in this particular case is I do need to own these businesses at their current price. And I'm not comfortable pushing Snowflake much more than it is at this particular price. But if it were to circle back and go back to, 290 or 275, I probably would sell something else and push it to 10% or 12%. So I think that's the relationship with price. We all know a little bit that there's a relationship there, obviously, but I look at that more as one of the final factors of my process rather than the first factor.
So what I'm understanding is that unless the price is really extreme, and intuition, everybody is gifted with intuition, and intuition can tell you that this price is too much, and you don't need any models for that, right? And then you say, okay, the Snowflake is a great company, but price looks a bit extreme, so I still want to go for it, but my allocation will be low. Is that what you're thinking?
Yes, and I think what happens is Zscaler, which I don't mean to jump around, but I think it's a good example. Zscaler had an awesome, what I think was an awesome quarter. So Zscaler had an awesome quarter, and today there was somebody put out an analyst report and put a downgrade, and they downgraded them and raised the stock price. They raised the target from 265 to 285 or something like that. But they downgrade, so they did the downgrade while they raised the price.
This was ridiculous, wasn't it? I mean, I read this morning.
And Zscaler dropped to like 270. I'm like, you know what? Zscaler had an awesome quarter. They've spent a ton of time north of $300 a share. They're back down to 270. They're down 13%. You know what? Upstart's down like 3% today. I actually sold a bunch of Upstart down 3% and put it in the Zscaler down 13%, because that at that price, I want to own more Zscaler. When Monday's, three in the 320s, and dropping down, I want to own more Monday. So again, it's about, we know these stocks are expensive, and we know sometimes they're going to be nosebleed. Very rarely, they're never cheap. Like there's always going to be somebody that goes, it's not cheap enough. It's never going to be cheap. Sometimes you might feel like it's approaching fair, but even fair is tough to get with a lot of these stocks because they're given a premium because of the outstanding business performance that they're doing. So if I feel like it's nosebleed, I might challenge myself to try and buy some, but I probably won't buy as much. If I feel like it's expensive, but just a kind of a normal expensive, I'm probably going to push it to the max of my comfort level for however big of an allocation I might hold. And if it's something like Zscaler at 70 off of that 270 off of this quarter didn't make sense to me, given that it was, well above 300 not that long ago. So at 270, I'm willing to stretch that allocation even further. So really, it's about more relative valuations rather than having like a valuation formula.
I get it.
Right, but it's more like you can pick any stock that you own. Like I'll ask you, like, what's your number one holding?
Mine is Tesla.
Okay, what was Tesla's price today, roughly?
I didn't check. I think it's about 1,000 something.
Okay, so let's say it's $1,000. If it dropped to 850, would you buy some? Do you like Tesla where you buy some at 850?
If I have money, yes. Right now I'm fully invested, and
all right.
Yeah.
But if Tesla went from 1,000 to 1,400, you might hold it, but you might not want to add more shares at 1,400.
I may not.
Correct?
Because simply
if the business hasn't changed.
Yeah, business hasn't changed simply because it's right now it's 20% allocation already. If it's got 1,400, it becomes 25, 30, and it's again psychology. There are a lot of people, Joe, who are 100% in Tesla because
correct. It's interesting because of the psychology. I had an exchange with someone. I had a bunch of people ask me after I put my monthly recap out, and we had the washout on December 1st and then December 3rd, so we had 2 in a row. And I had a ton of messages from people asking me, hey, did you spend your cash? What did you spend it on? So I just sent a tweet out and I was like, hey, my cash problem's gone. I put everything back in. And someone replied, very, very harmlessly, but someone replied, whoa, did you put it all back in or did you layer back in? And I said, hey, yeah, I get like the layer back in, but my portfolio had an 8% cut on Wednesday and was down another 7.5% on Friday. And it was down about 28% or so from my all-time high. And, I know usually those dips are 30, 35%. I don't need to catch it exactly right, but I might be wrong, but every time this has happened historically in the past, when I'm down 28% from my all-time high, we're closer to the bottom than the top. So how many layers do I need? I'm down 28% from my all-time high. And, my experience has told me that when your portfolio is down that much, if you have cash, I read all the time on Twitter or from people like, hey, excuse me, you should have dry powder. And that dry powder, when the market drops 20 or 30%, that's what your dry powder is for. Well, my portfolio's down that extent right now. And yes, the market's not down that far, but these companies tend to drop a little quicker early, and then they also bounce back quicker late. So if these are the companies that I'm investing in and I'm getting them at a 25 to 30% discount, I feel like now is the time to use the dry powder because that makes sense. Logically, that makes sense, and everybody says that. But when you're actually down 25% and you're looking at that sea of bright red on your screen when you're trying to buy these things, psychologically, it does make it very, very difficult to put that money back in. But logically that's what you're supposed to do, and sometimes it's just swallowing hard and doing what you know is the right thing in the logical moment, and then trying to keep that logic and keep your process intact when the inevitable emotions come, because that's what makes it really hard, not just for me, but for everybody.
Yeah, no, I get it. Personally, that's not a problem with me. I mean, if I have dry powder, if I believe in the business, I would go for it. No problem. But I think I understand. I mean, these days, I'm not even watching it because so many reds. I'm just avoiding, because I think market is just being, it's just like a dean of value investing. Ben Graham said that it's like market is like a bit of a bipolar. It gives
exactly, Yeah, and I sent this out maybe last week, and I all the credit in the world. There's a gentleman, and I know you follow him as well on Twitter, Gaucho Rico, and he wrote a phenomenal blog post detailing about 30% drawdowns from 2018 on. There was a big sell-off just like this in December 2018, and there was another one in 19. Of course, there was March of 2020 that we all lived through. There was another one in March to May of 2021 was not a good time for growth stocks. And everybody forgets that because their portfolios have doubled since like May, if you've held a lot of these names. And I think the one thing for me is I now, even with this, if you do this the right way, your portfolio will make higher highs at the peaks. But when you hit those valleys, it will make higher lows as well. So your low this time around will be higher than your last low. And where I'm at right now, even after this, 28, 29% drawdown, whatever it is, right now I'm about the same as my all-time high that I hit in February. So I was up, 20% on the year in February. I was down 15% or whatever it was in like March through May, where we kind of bounced around that awful spot. I went all the way up to 60% up for the year, and now I'm back down to 20 again. And so now if my valley this time around is going to be as high as my peak was in February, that tells me that my general portfolio is moving up and to the right, which is what the market does over time. I just want my portfolio to do that same thing. I just I hope that it has a steeper shape, because if it has a steeper shape, I'll have better returns in the market.
Right. I think a couple of more questions, and I think then we can call it off.
Okay.
How often do you look at prices, stock prices? I mean, like, once a day.
No, you know what? I'm way more in tune during earnings season. Obviously, and it's more about the company information for me. So, I have a separate email account. So I have a personal email account, and I have a separate email account that I use for all my investing stuff. And I sign up to the investor relations sites for my companies with that email address and everything like that. So I know any Motley Fool emails are going to go there. I know any message board emails are going to go there. Anything off Twitter is going to go there. Anything off my Substack is going to go there. Anything off my company's IR pages is going to go there. So that's almost like a work email now if I'm managing my portfolio. So if I grab my coffee in the morning and I sit down and I know that I opened that email account, I know I'm kind of going to work and I'm going to scan my information. And I do that, every day. I spend some time at least checking through that email. I scan it at some point during the day. I don't pay as much attention necessarily to the portfolio, to the price. Sometimes I might check it once a day. Sometimes I might go a couple of days and not. If I go away with my family, I don't. Earnings season, I pay a lot more attention, just because the sheer amount of information coming in, you have to stay on top of it. But I don't track it every day. I do have a spreadsheet that I use that I've used for years now that tracks all our portfolios, and it's all automated. All the formulas kind of come through. I don't scrape the prices in. I know a lot of people do that. I don't do that. I manually enter in 9 prices for my 9 stocks, and it just updates everything for me. So, I don't track it every day. And the reason for that, again, going back to what I said in the very beginning, I'm not buying stocks, I'm buying businesses. And if I buy the right businesses, the stocks are going to take care of it themselves. And I'm more worried about what the company does from earnings report to earnings report than what I am on what the stock price does from a Monday to a Tuesday, or from week to week, or even from month to month.
And technical analysis, do you use it?
I do not. And I don't mean that disparagingly. I know some people like to use it for entry points. I know they like to do things with the 50-day moving average or 200-day moving average. I know some people who have had some success with it. It just doesn't fit for me. I tend to let the business fundamentals drive my decisions, and I'm not really, as concerned about catching it exactly. And to the point where someone actually sent me a very nice note, like just a very good engagement on Twitter. And someone was like, "Hey, I know you just bought, we look like we're in this channel. We look like we still have a little bit the NASDAQ has a little bit to go in this channel before it bounces off the bottom. And I was like, yeah, so you're telling me based on the chart that I caught it on the downswing closer to the bottom than the top, but I didn't quite tick the bottom. I'm okay with that. That all that chart did was give me the exact mindset that I had when I pulled the trigger, and I said, we're down 28%, probably closer to the bottom than the top. Now's as good a time as any to get in because I like some of these, prices on these companies. So that's not meant to disparage anything with technical analysis, but I think I pay, and the people that I tend to interact with, we pay so much attention and follow these businesses so closely. We want to let business signals dictate whether we buy, sell, or hold, as opposed to what the stock might be on a chart. Because you know what, when somebody says, you know what, I'm looking, it's at a pivot point, and it's $80 right now, and if it breaks up, it's going to go 85 or 90, and if it breaks down, it's going to go 75 or 70. That's just a fancy way of saying you're not sure if it's going to go up or down. And usually, in all honesty, if it has a good earnings report, it's going to go to 85 or 90 or whatever it was. And if it has a bad earnings report, it might go to 75 or 70. It's kind of so my style is kind of based around the fact of, or a belief that the business leads the stock price rather than the other way around.
Okay. And leverage, you work on leverage options?
I don't. I do it sparingly. What I'll do is, like, because I'm fully invested, and I don't do this very often, but I did it here. So, with Zscaler, because I put all my cash in on Friday, and Zscaler, dropped today, I sold some Upstart to buy a little more Zscaler, but I also sold a few shares of Zscaler to buy a couple long dated options, dated in 2024. So I bought some long dated options for those that might do it. I bought some $280 calls, which was about the price, was in the 270s or whatever. I bought some $280 calls that expire in January of 2024. And I look at those as long dated options, or leaps, that for those that are familiar with it, I view those as kind of shares on steroids. Obviously, if the share price goes up, the leaps are going to go up more. The flip side of that is if the shares go down, the options obviously will go down more. Time really matters. I don't do a ton of short-term stuff, and I don't carry a large percentage of my portfolio in options. Gaucho Chris is outstanding at that. He's excellent at it, and he writes about it very, very clearly for those that are interested. I tend to do the majority of my stuff in shares because, if, like I said earlier, if I get the companies right, the share price will take care of itself. And as long as I'm beating the market, I'm okay with doing it mostly in shares.
Okay. I think two more questions I have, and then I think I'm taking too much of your time. I apologize, Joe, but since you're here.
No, I appreciate the conversation. I realize crowdsourcing and the engagement that I get with people that give me feedback is very, very helpful, and I'm happy. I'm flattered that you asked, and I'm happy to answer questions. I hope it's helpful.
No, I think look, I'm getting amazing value. I'm learning with each answer. I'm sure people would. The question which I have is what do you invest like this always?
Well, did I invest like this always, or
how did you evolve as an investor?
You know what? I've always managed our portfolio, my family's portfolio. I've always done it myself. And I joined the Motley Fool in the mid 90s, 1997, I think. I joined the Motley Fool, and I'd get the recommendations, a couple of their services, a couple stocks a month, and I bought a lot of their companies and long-term buy and hold. But I always managed it myself. And they used to have they don't anymore, unfortunately, but they used to have a nifty little portfolio tracker where you could enter in all your buys and sells, and it gave you your XIRR, kind of your rate of return against the market. And I tracked that for a long time, probably for about 15 years. And I had beat the market by about 2% a year, which is, not a great, I guess, performance, other than, if you're doing 2% a year for 15 years, you're that compounds, and you're doing pretty well. And a lot of it, being honest, was long-term, just luck. It was long-term buy and hold luck. I bought Apple in 2008. I bought Starbucks in 2007. I bought, Under Armour in 2010, and it's not as attractive now, but I got out of it in 2014 for a pretty good profit. I had a couple of companies that were bought out. And about 2018, I found Saul's board. I had a 401k that I rolled over, and I had about 25%. I had about 25 positions, and I had about 25% cash. And I realized my portfolio was getting a little scattered, and I needed to take better control of it. And I was like, I'm either going to do this myself or I'm going to hand it off to somebody, but it's getting large enough now where I need to pay more attention. And I found Saul's board in 2018, and just the style behind it really clicked. And I think not just the style of the growth investing, but the psychology, like knowing what you own, knowing why you own it, being able to set expectations and hold your companies accountable and come up with a process that just fit for me as an investor. And I wasn't concentrated at first. I cut down to about 15 positions, and now I have about 9. So it did take a while, but I think the big thing, like going back, it fit my temperament. It fit my goals. It fit my time that I had for it. So I didn't always do this style, but I believe I always had the underlying temperament and capability to do this style. I just didn't have the framework. Finding that board was what gave me the framework to have my style be what it is now. And I think that applies to anyone that invests. It's about honing your process and making it better, but also within the framework of what works for you individually.
And how would you feel, for example, I'll give a hypothetical situation in 2023, S&P market returns are 20% and your portfolio returns are 10%. What's that feeling like, and what would you do?
You know what? I'm in checking my process. I'm going to try and see if I made a mistake in my businesses. We can't control our returns. We can only control the quality of the businesses that we pick. And if I still have all the best businesses amongst the businesses that I focus on, and all the multiples are reset, and that's the reason that it trailed the market, well, I can't control multiples. I can only control the quality of the businesses that I pick. And I'm not trying to hop to the next best thing. I want to try and have a process that works for me. And I don't want this to sound facetious, but if the market returns 20% next year, my portfolio only returns 10%. Well, while the market's returned, whatever it's returned 70% or something in the last 3 years, I've made multiples on my portfolio. So, over that short time frame, in that short time frame, I might underperform. If I zoom out to the longer time frame, I'm still overperforming. But I think more importantly, I view your returns as a gauge on whether or not your process is working. It's more of a guidepost over time as to whether your process is working. So if my returns are not lining up and not beating the market, I'm going to double check my process, not because I'm driven by returns, but because if I'm picking the right companies, my returns should take care of themselves. And I might look at that and double check and go, you know what? I'm comfortable to continue doing what I'm doing. Like I didn't beat the market last month, but I didn't try and change my style because I didn't beat the market last month. I still believe that the style that I have and the method that I have and the process that I have is going to allow me to beat the market in the long run.
And last question, if you were to pick one company today, which people should look at, it's not a recommendation, Joe.
Right.
But what company, let's say, what will you suggest me or suggest people, guys, this is the company you should study, and
I don't mean this. It's the company that I own 26% of our portfolio in. It's Datadog for the simple fact that I own so much of it. And I thought it was interesting last year. I might send this out again. Somebody sent me a message and was like, "Hey, what are your best ideas for 2021?" And this was the last week of December or whatever, 2020. And I ended up tweeting out and I was like, "Hey, my best ideas for 2021 are the companies that I own right now, because I always own my best ideas. And if you don't own your best ideas as an individual investor, you might want to take a look at your portfolio. Because if I said to you, hey, what should you look at? And you're like, oh, you really should look at these 5 names. And I said to you, well, how many of those names do you own? And you were like, well, I don't own any of them. Well, then maybe you should look at those names as well. So when I get asked that question, I feel like every month, I remind myself of what companies I should look at by just looking at my allocations, because I anytime my conviction changes in one of my companies, I change the allocation immediately. So at any given point in time, when you look at my portfolio, those are my best ideas in the order that I rank them. That doesn't mean that I'm right. We are wrong as investors all the time. But in trying to do the best I can to manage my portfolio, my current holdings at my current allocations, that's my best effort at trying to manage my family's portfolio, period.